Hello and welcome to this Commerzbank webcast. The US and Germany are close to full employment. In these countries especially, wages and consumer prices should be the first to rise at a faster pace. But even here wage growth is picking up only slightly. Why is that? Firstly, low wage inflation is due to globalization. China and other countries opened themselves up to the global market at the beginning of the 90s. The global labor supply has increased by many millions of workers. The rising competitive pressure has forced workers in the industrial countries to make wage concessions to secure their jobs. Secondly, disappointing productivity growth is limiting the scope for distribution and thus also the growth of wages. Wrongly placed investment during the time of the housing and debt bubble is still lowering productivity growth. What's more, low central banks' interest rates are keeping highly indebted and unproductive companies afloat. Thirdly, inflation has generally been falling since the beginning of the 80s. Inflation expectations are thus very low and firmly anchored. Consequently, trade unions are not making much higher wage demands when inflation does rise in the meantime, for example on the back of higher oil prices. All these braking factors will only abate very slowly. Much higher wage increases are therefore only to be expected in the longer run. This applies all the more to countries that are lagging behind the US and Germany. In the Eurozone especially, with its very high unemployment rate, wages will continue to rise very slowly. Consequently, core inflation will remain low. The ECB will not achieve its inflation target quickly and will leave its key interest rates low for a longer period of time after bond buying ends. Thank you for watching. For more information, please enjoy reading our Week in Focus.